Mike, it's great to hear from you again. And do you think the market here has temporarily found a bottom?
Hi, Kelly. Thanks for having me. I do think that risk assets have temporarily found a bottom, but whether that's sustainable is largely going to depend on whether policymakers continue to get traction on some of the reflationary policies that have been put into place, and also the news flow of the pandemic itself, which has been worse very recently, unfortunately.
Right. So we have just today this study, I don't know if you've seen it, from the St. Louis Fed, that suggests we could have 50 million people out of work and a 32% unemployment rate, which is worse than the Great Depression. What is and they admit it's a back of the envelope calculation. It's not super scientific, but what do headlines like that suggest to you?
Yeah, I mean, these numbers seem to get scarier and scarier with forecasters almost trying to one-up one another in terms of scary numbers. But the U.S. economy has essentially come to a sudden stop here, along with much of Europe. So we're going to see some very nasty numbers. We don't have a lot to go on so far. Probably jobless claims, which soared last week, is the first line in what's likely to be a continuation of a raft of pretty negative numbers. Even if you adjust that claims figure for the size of the labor force over time, it was about 60% above previous record highs. The unemployment rate peaked at about 10% at the end of the Great Recession. So, the jump in claims that we've seen, and it's probably going to get worse from here, could be consistent with 16% unemployment. So I wouldn't necessarily write off any of these scary numbers, but the key is how quick do we recover? Eventually the pandemic will end, right? Even the Black Death ended, the Spanish flu ended. So pandemics do not last forever. We have to have policies in place that are strong enough for a V-shaped recovery so we can get back to full health without another lost decade for the labor market.
And you think the Fed could communicate that by saying it's going to get GDP back on its previous growth trend? We can probably show the chart illustrating this. But do you think that would ever work as a communication message to the entire country?
I think it would help, because one problem central banks face, not just the Fed, but even more acutely in Europe and in Japan, is a lack of credibility in terms of policies staying in place long enough to actually vault inflation and economic growth back to where they would have been before these shocks have hit. And so it sort of looks like you end up in a liquidity trap pushing on a string. But really, that's simply because markets know full well that central banks have historically pulled back before there's any real inflation. So in this case, I think it could help policymakers get more traction. And fiscal policy, there's a lot of emphasis on that now. If we want it to be more effective, I think if the Fed did communicate a level path target, whether it be for inflation or inflation plus real growth, nominal GDP, that could be quite helpful in ensuring a V-shaped rebound after what's likely to be a pretty brutal recession. Hopefully it's short-lived.
Right. But like you said, keeps us from turning a temporary slowdown into maybe a permanent loss of wealth.